Good afternoon. Today is March 17th, 2021. This is Wall Street Wednesday with Professor Milligan. I want to welcome you guys. Hey Lance, how are you? Just a quick reminder. Hey Lance, how are you? Just a quick reminder, guys, that these are all my opinions and thoughts about the market and about particular trades and stocks. Anything that you hear on this call, again, is my opinion. And also, if any of my listeners or viewers actually chime in with their ideas, opinions, again, it's their thoughts and ideas and opinions. If you choose to look at these ideas any further, I highly recommend that you speak to your wealth advisor, your broker, whoever it is that you get your financial advice from. All right, so that's my disclaimer. I'll say it a couple more times during the day. Welcome, Twin. Welcome, Lance. Ham, how are you? So, some pretty exciting stuff going on. I'm just going to give it a couple more minutes to see if anybody else wants to join. Happy St. Patrick's Day. I was not able to find anything green other than my light green shirt, so I did find something green. Happy St. Patrick's Day. Contrary to popular belief, Milligan is not Irish. Milligan is actually Scottish. All right, cool. Another interesting day in the market. While I'm waiting for people to sign on, let's talk about Powell. Fed Chairman Powell basically has been in front. He's been having conference today, been speaking all day today. A couple things that he said were somewhat important. At least I think they're important. And that is, one is he does not foresee raising interest rates until 2023. All right, he said, let's not even discuss it. He goes, it's off, it's way off in the future. So right now, basically the Fed told the market, which is one of the reasons why the tech stock started to run. The Fed has told the market that these low interest rates are going to be here for a while. And by using these with these rates so low, a couple things happen. One is with low interest rates, as we know, what it does is it lowers the risk, quote unquote, in our modeling to actually come up with valuation. So a low risk-free rate, low T-bill rate actually is going to increase the intrinsic value of a stock. Without getting too technical, basically with low interest rates, it's going to make stocks more attractive. Simple English. The other thing that's going to happen too, which is also going to be interesting to see what happens, these low interest rates, which are showing up in the bond market now, is going to make investors have to chase yield. It's going to be interesting to see where they go, how they do it, but they're going to chase yield now. Think about this, for those who are actually living off of fixed income or living off their retirement income, income off their retirement, off their investments, those investment yields have actually dropped substantially. So it's going to be interesting to see what they're going to do. I imagine it's going to force investors to actually look at a lower grade fixed income investments, lower grade, and possibly look at stocks that have a high dividend and possibly could increase their dividend yield from year to year. All right, so that's that. What else? Powell said that recovery's coming. The recovery is actually happening faster than what they expected. He's talking about possibility of inflation and growth. So basically he gave a good sign and said that things are looking well and that we should see things continue to prosper and to move forward, which is going to have a direct impact on our investments. All right, so you saw some of your tech stocks start to run today because of that. A couple other things real quick. There was a couple IPOs. Oh, let me back up. Roblox. Somebody actually told me how to pronounce it. Roblox. I've been pronouncing it Roblox. So I had mentioned last week that if Roblox had got through 74, I'd be a buyer. Stock went through 74 to 78. I backed off, no question about it. And the reason why I backed off was because of what was going on with the tech stocks and with Nasdaq. So I just backed off of it. And by the way, the stock actually hit 78 today, which is an all-time high. Volume was relatively light, and then it hit that, and then it pulled back and closed. I got to check the close, but I'm almost positive it closed below where it was yesterday. So I think today's close was lower than yesterday's close. I'm going to check it right now. All right, so it basically closed right where it was yesterday. So it closed flat. Closed at the $76.96, which is pretty much where it was at. What else? Tech and Nasdaq still a concern. Tech and Nasdaq's always a concern, but like I said, the news that came out today from the Fed chair, it should put a lot of people at ease. One is, again, these lower rates. Two, what it does is with these lower rates, it actually increases valuation. So I wouldn't be surprised to see the tech stocks to have a little bounce here, start to move a little bit. One of the things which I'm pulling up now that I look at, and I'm looking at it again, is the VIX. Bear with me a second while I just add my Bollinger Band to it. For those who know me, know that I always put the Bollinger Band when I talk about the VIX. And what's really interesting is the VIX penetrated the upper Bollinger Band, which gave me the buy signal back on March 5th. And now it's actually running low. Now understand, the VIX is based on the S&P 500. And based upon what we're looking at now, and let me just change this from 2 standard deviations to 1 standard deviation. Yeah, bear with me 1 second. And when I do that, I'm just changing the inputs a little bit. So I'm going from 1 standard deviation, 2 to going to 1. And for those of you who never use the Bollinger Bands, and I wasn't really looking to go into technical analysis, but I guess I am. For those of you who use Bollinger Bands, 2 standard deviations encompasses 95% of all possible outcomes. 1 standard deviation is 66, 67% of all possible outcomes. And one of the things I do with this is I'll put my chart on it, which I did now. I put my VIX on it. And right now the VIX is running outside 1 standard deviation, the lower Bollinger Band. What this does is it confirms, for me, it's a confirmation that the VIX is actually moving lower, which again means the market's moving higher. It's a contrarian indicator. So that's one of the things I use. When I set it for 2 Bollinger Bands, what happens is those are the extremes. That takes you out to the tails. Again, if you're not into technical analysis, you're not into the statistics on this, no problem. All I'm saying to you right now is that the VIX is confirming that the S&P is in a positive uptrend and moving higher. All right, let me get rid of my Bollinger Bands now. Let me close this out. The other thing I want to talk about was, Andrew, how are you? Welcome. The other thing I want to talk about real quick before I get into my pricing model, my pricing indicator, is the commodities. So once again, last week I gave you some. This week I'm going to reaffirm. There's a couple of commodities right now that actually have fundamentally, technically given us the signal to either go long or go short. Again, and what's interesting now is, and some other things that are happening. So let me explain what I mean by that. Gold. Go long gold. I just got a buy signal on gold through the VIX. Through the Bollinger Bands. I got a buy signal on gold. Fundamentally, gold is actually has penetrated above the 10-day moving average. And here's what's really interesting. Right now, the commercials had the largest in the last 52 weeks, the largest long position, which means that the commercials are actually long in gold that we've seen this past year. So again, the commercials, as gold actually started to drop a little bit, the commercials were in there buying, and they now have the largest long position that they've had in the last 52 weeks. That's extremely bullish. The other one, believe it or not, that's also on the long side that looks just really good is the dollar still. So again, the dollar's moving higher. It's running. Fundamentally and technically, it's a buy. The other one that's actually really ran and done really well is Palladium. Palladium's actually up 10% from last week when we talked about it. And it's showing no signs of slowing down. Before I go any further with this, one reminder, if you're going to trade commodities, you must have some type of hedging strategy involved. All right. If you're not going to hedge it, then the only thing I would recommend is either just buy the call or buy the put. Again, if you have no idea what you're doing in commodities, you just listen to this, or you're just starting to get involved in commodities or currencies, only thing you should be doing is buying either calls or puts. All right. Buying calls if you're bullish, buying puts if you're bearish. Do not write any derivatives. Repeat, if you're a beginner, this is new to you, do not write anything. That's going to give you unlimited risk potential. Hey, Tommy, what's going on? Long time no see. Hopefully everything's going well. So with that said, again, if you're going to listen to what I'm saying and you decide to get involved, either hedge it, and there's a whole technique behind that. And if you don't know what I'm talking about when I say hedge, that means don't do it. G2, how are you, sir? So again, if you're going to go long, just buy the call. If you're going to go short, buy the put. Do not write any options. So again, My disclaimer again, these are my thoughts, my opinions. If you like these ideas or want to do anything with these ideas, I highly recommend you speak to your broker, your wealth advisor. The other thing that is screaming, again, 52-week high in terms of the commercials, in terms of how much they own. And again, it started to actually run. It's even your technical indicator as well as fundamental. It's the 2-year treasury. And I had a hard time with this because what it means is if you're going long the 2-year treasury, it means that you think rates are going to go down on the 2-year. I'm not sure how much lower they can go, but the bottom line is the commercials have taken the largest position in terms of being long the 2-year treasury that they've been long in the past 52 weeks. All right. All right. On the short side, wheat has started to break down fundamentally and technically, and wheat has the largest short position they've ever had in the last 52 weeks. And wheat's actually breaking down. If you're short, corn has actually tried to rally a little bit, but it's still in that narrow trading range. If you went short corn, stay short. What else? Lean hogs. Lean hogs. Fundamentally, they have not broken down, but technically it has not broken down, but fundamentally, again, the commercials are getting short. A 52-week high on the short. Lean hogs is running to the upside. The commercials are selling it as it goes up to the upside. So again, and one of the things to take note, and I've said this before, lean hogs, feeded cattle, and live cattle. Those markets are subject to short squeezes like you've never seen before. Some of the worst or best, depending on what side of the market you're on, in terms of short squeezes, have come out of the softs, the meats. So again, I'm not surprised that lean hogs is running, and I'm not surprised that as it's running that these commercials are getting short. Seen it a number of times. So keep an eye on that. What else? Cotton. Stay short. If you're short cotton, stay short. On the upside, believe it or not, the 10-year treasury, the ultra 10-year treasury, go long. Yields are going down, prices are running. Excuse me, I got it backwards. Go short, yields are going up. Go short on that. Something else that hit my list that normally I don't talk about, but I guess I'm going to bring it up, is crude. Crude oil, the commercials actually are net short crude oil, again, a large amount, they're net short, and it's interesting. And I normally don't get involved with crude because of the fact of it's geopolitical, but again, that's what I'm seeing. The other one that has also become really interesting right now is high-grade copper. High-grade copper for you technicians right now has a pendant flag. And you guys know the pendant flag basically is neither bullish nor bearish, but when it does come out of that pendant, it usually breaks hard. So again, we're calling high-grade copper to the short side. It's in that pendant. When it does break out, I believe it's going to break to the downside, and that's why if it does, it breaks that 10-day moving average, you want to get short. I've given you a lot to talk about, a lot to think about. I'm going to go through my list one more time. I'm going to go through the longs. I'm going to go through the shorts. So on the long side, and all of these are actually breaking out, and all of these, I think that, fundamentally, technically, they're actually working right now. So long, the dollar, high-grade copper. Oh, excuse me, I'm sorry, reading the wrong thing. Gold, the dollar, gold, palladium. The other one I didn't mention, which I should mention in terms of currency, is the Mexican pesos. Yes, the Mexican pesos, it ran for me early, about a year ago, and it's starting to run again. So I'd play it to the long side. The other one is the 2-year treasury. These are all long positions, all positions I think will go higher. On the short side, corn, wheat, soybean, natural gas. This is my first time putting up natural gas. Natural gas is actually a short. It's been breaking down. Natural gas, lean hogs, live cattle, high-grade copper, cotton, sugar. New to the list, crude oil, the British pound, the Aussie dollar, the New Zealand dollar, the ultra 10-year treasury. All these are shorts. All right. So that's my commodities. If you have any questions, feel free to ask me, but that's what I'm talking about. That's what I'm looking at right now. All right. Now, the other thing that I had put up, and for those of you who don't have it in front of you, I posted it earlier, and that is my PRCSMM. And let me again do the best I can with these fingers of mine. PRCSMM, PRCSMM. That's the acronym. Hey, Christian, how are you? PRCSMM, PRCSMM. All right, what does a PRCSMM stand for? It's an acronym that helped me because, again, with the memory. So P stands for product or service. R stands for reward to risk. C stands for capital. S stands for scalable. M stands for market. And the other M stands for management. All right. If you go back and look at any of the great performing companies, go back and look at the FANGs, go back and look at any of these companies, what you'll see is they have these 6 criteria in common. I'm going to spend a couple of minutes over the next couple of weeks breaking PRCSMM down. One of my former students was having a discussion with me, and I started talking to him about catalysts and what drives markets, and I brought up PRCSMM, and his comment was, I have never heard anything like this. He goes, wow, can you explain it more? So at that point I said, it's a great time for me to bring this out again and explain it to all investors. I think whether you're a short-term trader, a long-term investor, I think that PRCSMM will help you. My belief is, and having traded, I found it much easier to trade stocks that are doing relatively well, going up in value, than it is to trade stocks that are very volatile or dropping in price and all over the place. So I found it easier to trade those kind of stocks. And this model, this criteria I use, helps me determine it. So today I'm going to spend a couple of minutes and just talk about P, product. And as I talk about these different acronyms, I want you to start thinking about what you consider the best performing companies in the last 5-10 years. The ones that you looked at, the ones you say, wow, I wish I'd have brought this, 5 years ago, 10 years, the Microsofts of the world, the Facebooks of the world. I want you to think about those kind of companies as I bring up, as I start talking about PRCSMM, and today I'm going to talk about product. So, one of the words that's been floating around on Wall Street for a long time is disruptive. Is the company disruptive? Is the product disruptive? Is the service disruptive? And a lot of people having a problem kind of figuring out disruptive and what they mean by that. So let me do a couple things. A disruptive product is a product that at some point in the future can and will become the industry standard. A disruptive product is solving a problem that's out in the marketplace, but it's solving that problem with a different version of a product that's already on the marketplace. Let me explain real quick. And I'm going to go back. I'm going back several years, and the reason why I'm going back is because I want to make sure that you understand what's going on here and you can look at this. Let's talk about Toys R Us. All right? And by the way, product or services don't have to be new technology, but let's talk about Toys R Us. Toys R Us came out with a whole different business model that disrupted and changed the way that people brought toys and brought hobbies and brought toys. Prior to Toys R Us, and again, this might be before most of you guys this time, but prior to Toys R Us, if you wanted a toy or anything like that, you went to the grocery store where they had one aisle that was filled, that had different toys on there, and or you went to a hobby shop, local hobby shop, that had all the little toys in there, models and toys that kids would like to play with. All right? That's pretty much where you had to go to buy your toys. Toys R Us came around and said, we're going to be a category killer. What we're going to do is we're going to actually build these super mega stores that have nothing but toys in them, every toy you can imagine, and because we're buying in bulk and quantity, we're going to have a cheaper price. But for us as consumers, it now meant we could go to one place, one time, and buy all the toys we wanted. What it did was it changed the category. It changed the way that consumers brought toys. That's a disruptive product. All right. That product disrupted the industry. It consolidated the industry, and it came up with a new product. Now, by the way, during this time when Toys R Us was doing it, it was putting up double-digit growth, up in the 15, 20%, and the stock did extremely well. Now, I'm not talking about what it did now. I'm talking about what happened. forward-looking people realized they came up with a new product, a new way of doing things. A lot of times when these new products and services come to the marketplace, they might literally be the only one out there doing this. And what I mean by that, the only one out there that you can actually participate in what you believe is this new trend, this new disruptive product that's coming to marketplace. Give you another example. Tesla came up with a disruptive innovation. What they did was they took an existing product that was in the marketplace and they innovated on that and came up with a whole new product. Now they did not create a new market from that, but what they did was that innovation came about. And then let's go back a step further. If you believed in the electric car and its future, the only way you could play that was to buy Tesla. It was the only company out there that was publicly traded that you could actually get involved with that was actually doing this. That's a disruptive innovation of a product. Let's go a step further. And I know you guys know this. And I see some of my former students on here, so it's kind of funny. I know that back in 2007, I think it was, 2008, some of my students and I were buyers of Netflix. All right, we started buying Netflix. They started buying Netflix. We talked about Netflix. Netflix is, again, another company that basically took a traditional model and developed another business model around it for delivery of DVDs, all right, and CDs and games. Prior to Netflix, you literally got in your car, walked, drove to a video store, and you got your videos. Netflix came around, and for those who originally understand how Netflix really got, Netflix came around and said, look, you don't have to go to the store anymore. Here's the deal. Go onto our website, order your videos. We'll send them to you. We'll mail them to you with a return envelope. And when you get done watching them, just put them in the envelope and mail them back to us. So what they started doing was they actually had the similar product, but they said, look, we can come up with a new way of delivering it. Then what Netflix did, again, they kept innovating. Then what they did was they said, okay, we can now stream these videos directly to you. So once again, not only do you have to go to the store, but you don't have to even deal with the mail. We can stream them directly to you. Now, one of the things that happens when you have a disruptive product or service, you literally change the industry. You create a whole new market, you can change things. Well, what Netflix ended up doing was they end up running Blockbuster and Hollywood videos right out of business. Ran them out of business, all right? And why? Because their product and their services were so disruptive, it changed the way that we actually got and viewed videos on demand. When you find a company that has a disruptive product like that, one of the things you want to look at and say to yourself is, one, how disruptive is this product? In other words, can it literally change the way business is done? Can it change the way that we do things? Two, can that product become the industry standard? If it becomes the industry standard, once again, it's going to be the go-to in that industry. Again, an example of somebody that's become an industry standard, the word Kleenex. All right, Kleenex now has become the name that everyone uses for tissues. Well, Kleenex was a brand. All right, tissues are tissues. Kleenex became a brand, but now you have people say, can I have a Kleenex? Do you have a Kleenex? Why? They changed. That product was so disruptive. It changed the way that we look. They dominate the market now. They become the standard. All right, I get excited when I talk about this. Now, let's go back. The other thing that happens too is a lot of times, and I mentioned this, the company is only one in the marketplace at the time that actually can take advantage of this. What comes to mind right now is Beyond Meat. All right, Beyond Meat is changing the way that we can actually get protein into our diets. All right, now don't get me wrong. There's other companies doing it, but if you want to play the Beyond Meat, you want to play the plant-based protein in the marketplace right now, it's only one place to go. And that's Beyond Meat. All right. Product and services can be disruptive. And once they are disruptive, the next question you got to ask yourself, one is, can they become the industry standard? Two is, can they actually end up creating a whole new market that was never existed before? We've seen this also, where these companies come up with a product or services and it ends up becoming a whole new entire market. Now, again, without going into too much detail, we saw that with the internet. The internet created a whole new product and service that ended up creating a whole new market, which was the Internet of Things. So all I'm saying to you is, in our pricing criteria, and I want you to think about it, and I put on Instagram, I put up there the FANGs. I want you to think about the FANGs. Facebook, Apple, Amazon. Again, depending on who you are, Netflix, or some people go with Microsoft, Google, which is now Alphabet. All right. You look at those companies, and one thing that stands out for all of them is their product was so disruptive. Their product has now become the industry standard. Their product has now become the go-to product in their marketplace. That's what we're looking for. Those are the companies that we want to look at. Those are the companies that we want to digest. Those are the companies that we want to be owners in. All right. It's going to take some foresight. It's going to take you some digging. But as you do that, ask yourself, what's the competition? Who's the competition? Have they changed the way things have been done? That's a disruptive product. And a lot of people think they're disruptive. And I'll say this to you. A new and improved version of a product that's already in the marketplace is not disruptive. A new and improved version of a product that's already in the marketplace is not disruptive. So if Milligan Donuts, as you guys know, my favorite company, comes out with another flavor of donut, it's not disruptive. All right. And the reason being is because all I did was I just got a new and improved. If I want to be disruptive in the donut industry, I've got to come up with maybe another way of making donuts, not a different flavor, because the bottom line is anyone can actually duplicate flavors. So can I come up with a better process, a faster process, a cheaper process, maybe a process that requires less oil? Who knows? But the bottom line is, just because I make something better than it was is not necessarily disruptive. All right. I'm going to leave that for now. I beat it up. Let me back up. When you start looking at these criteria, and I talk about, one of the things you got to do is you got to start figuring out how to score the criteria. So again, on pricing model, the pricing model is a criteria to help you find what I call the next big thing, the next big winner in the marketplace. And by the way, as you go through the pricing model, stocks will start to fall off the list because they don't have all 6 criteria. Also, what happens though, you'll have some stocks that you'll keep on the list that might not quite be there yet. They might be on the verge, which means that they're on your watch list. You keep a eye on them and watch their development, and you say, wow, look at what's going on. Look at what they're doing now. The other thing about the product when it comes to pricing, if the product is so disruptive, what happens is you'll see competition start to create a duplicate product to try and compete with that marketplace. In most cases, though, if this company is really disruptive with their product, they've got a head start on the whole industry. They've got a head start on everybody, and now it's basically just play catch up with them. So again, think about the different companies out there and ask yourself. And I'm laughing because I've had a couple of clients. I'm thinking about one client I had, and he said, well, Mike, my product, he asked me to work with him. He said, my product is disruptive. And I asked him, how's it disruptive? He said, well, my product has a different flavor than anything else out there. And my comment to him was, well, one is there's another company that actually is producing the same thing, the same flavor, one. And two is, if yours does really take off, it's not impossible to duplicate that flavor. You can't put a patent and lock up that flavor where you dominate it. Therefore, anyone else can do it. So therefore, your product is not disruptive. You basically might have early entry into a new flavor in that marketplace, but you did not come up with a disruptive product. All right, so that's the hard part. A lot of times investors think they found it. It takes a lot of work. And as you guys know, not every company's going to have a disruptive product. Not every company's going to change the way we do business. Now, sometimes the industry or the marketplace might make a product disruptive. All right, so again, that might happen too, which we saw with Zoom. And what's interesting with Zoom is Zoom was in the right place, right time, disruptive product. Don't get me wrong. Yes, there's other web services that you can go to, or meetup groups that you have. Google has one for free. There's other ones. But again, if you think about it, when you talk about meetups online, when you talk about anything like that, the first thing that comes out of your mouth is Zoom. And if I say to you, hey, we're going to have a Zoom meeting, immediately you know what that is. People talk about, hey, let's have a Zoom meeting, even though they're going on Google. So what that tells you is Zoom now has become the industry standard. Zoom has become the go-to. All right? That's what you're looking for. All right? Can competition come in? Of course they can come in. But Zoom right now has got to jump on the marketplace. Zoom is the one. Now, I have not looked at Zoom stock, but again, there's other criteria we go into. So we're not buying Zoom just because it has a great product, disruptive product, but again, that's where it starts, product and service. All right, I think I've discussed that enough. Next week, I'll pick up reward to risk. And again, notice I didn't say risk reward, I said reward to risk. So we're gonna talk about that a little bit, and I think you'll enjoy it. So that's my discussion on Pricem, and today we talked about the P, the product and / service. All right. Now I'm looking to see if there's any other questions. Any other questions in here? I've covered everything I wanted to cover today. I don't see anything. I'm just looking through to see if there's any other discussions or any other questions in here. I know I talked about this, but let me just jump back to the commodities real quick. Again, for those of you, when I talk about commodities, I give you the fundamentals. Every now and then, which is happening recently, I'll also add in the technicals when I see it happening. So in other words, fundamentally, I think something's a long or a short based upon my research. And then after I do that, I tie it to the technicals, and the technicals basically tell me when to get in, when to get out. Now, I say that for a couple of reasons. My strategy is a trend change. My strategy is not a short-term idea. Some cases it might work short-term, but when I say I'm looking for a trend change, I'm literally looking for something that was been going up for the last 6 months to now turn and start going down over the next 6 months. I'm looking for a trend change. So with that said, and if you go back to some older videos, I talked about how to put together a hedged synthetic. If you have no idea what I'm talking about, go back and find those videos. If you know what I'm talking about, I would not take a commodities position unless the position's either hedged or I'm just buying the call or buying the put. If you don't know what I mean by synthetic hedge, if you're not understanding what I mean by hedging your position using derivatives, then my suggestion to you is if you decide to start going into this market, this arena, that you only buy calls and you only buy puts. Quick reminder, in the commodities market, if you're buying an option, the most you can lose is what you paid for the option. If you're writing options or you're buying the futures, you have unlimited loss potential. I don't want you to get into a position where you have unlimited loss potential, especially if you are a beginner. I cringe sometimes when I hear people talking about how they brought some options and what should they do, and should they buy more, should they sell, and they don't even know what they own. All they know is they brought it at one price and it went higher. These are people that are getting their recommendations from somebody else, and as they're getting these recommendations from somebody else, they don't even know themselves what they're doing or what's going on, which is a very dangerous place to be, especially when you're talking about options and derivatives. So again, check with your advisor, get some really solid advice on this. And again, if you're going to trade these options and you're not sure what you're doing and your advisor's not the best when it comes to derivatives, we all have our areas of expertise. We all have our areas of specialty. If your advisor is not someone that's really familiar with derivatives and that's not his area of specialty, then again, my advice is to only go long a call or go long the put. If you're bullish, the underlying asset, you want to buy a call. If you're bearish, the underlying asset, which means you think the price is going to go down, then you want to buy a put and just leave it at that. All right, couple other quick notes. The IPO calendar, some things have come that's starting to look really interesting. We had, was it Sun? I got to get the name right. I'm looking at it now. Sun, I'm on the wrong page. Was it Sun? Gosh, hold on a second. I have it right here. Bear with me a second. I can pull it up as soon as I get my mouse to work. Come on, mouse. Sun. Of course, that's not it. There it is. Sun Country Airlines, SNCY. Priced at 24 today. Opened up and SNCY. And trade as high as $38 a share, closed at 36 and change. So again, that one worked. Keep an eye on it. I don't know much about the company. I do know this. If you're an airline, this is the perfect time to go public right now. Why? The airline stocks have been beaten up, so they're all trading at low multiples. The other thing too is that the pandemic looks like we're on the downturn, which means it looks like our economy is going to be up and running relatively. When I say soon, by the end of the year, we should be back up and running from everything I'm hearing and reading. And that means that air travel and everything else is going to be coming on again and increasing. Perfect time to go public. So again, I haven't looked at the company per se, but perfect time to actually, if buy an airline stock. Buy an airline stock, put an IPO. From what I can see right now, it looks like you have nothing but upside potential. But again, and it's a regional airline, competing with Southwest Airline, that nature. But again, I'll look at it in a little more detail. The other one that came public today, which also did extremely well, is, where is it? Where is it? Come on, Mike. Those are coming public tonight. There it is, OLO. OLO, I guess. I'm guessing, OLO. Priced at 25. They were calling up $2 to $3. And the stock ended up going up and closing at $34.75. Opened up at 32. And again, opened up at 32. This was a stock that was priced at $25 a share. The low for the day was 29 and change. The high was 35, and it closed right near the high. So I would, again, something to follow, something to keep an eye on. And then the other thing I was going to bring up is tonight, you got a couple of deals coming tonight that should take off and do extremely well. Let's keep an eye on them. Just looking for the names again. One is Duckhorn Portfolio. Yes, that's the name, Duckhorn Portfolio. The other one, and I'm going to butcher the name, guys. You've been around me enough. Tuya, T-U-Y-A. I believe it's out of China. Tuya, T-U-Y-A, ADR. They're calling this one up $3 to $5. Probably be up more than that. And there's a third one, and the third one's a biotech. They're calling up $1. As you guys know, I'm not a big biotech fan. All right. My own portfolio right now, I've got 2 positions. I'm only holding 2 positions. Everything else is sitting in cash. 2 long-term positions. So everything else is sitting in cash. And again, my long-term positions on these 2, they're still significantly higher than what I paid for them. But again, they did come under pressure, and I'll stay with them a little longer and see. And one of them is the Palladium, which you guys know I already own, PLTR. So I brought it up, PLTR. So I'm still long that. And I actually added to my position. So, but again, that's just me. And one other thing, guys, and I talked about this last week. I know I'm redundant, but don't buy the dips. Just don't buy the dips. Really, I'm not buying dips, and I don't believe in buying dips. That's how this whole discussion on pricing came about. My whole discussion on pricing came about because one of the things I was talking about was buying the dips, and I said I'd rather buy a winner that's going higher than buy a company that was doing okay that had some dips trying to guess the bottom. So one of the things I'll say to you guys, and again, I'm not trying to be funny here. If you had brought any of the FANGs, if you had brought any of those or anything like those and just held on to them, even when they pulled back and so forth, if you're a long-term investor, you were fine. You were fine. That's the one thing about these great companies. When they hit these 6 criteria, they typically weather storms. They really do. All right, I'm just looking. Any other questions? I don't see any other questions. I don't see any other questions. All right, so if there's no other questions, I'm going to pretty much wrap this up. I'm sitting here looking, and I don't see any questions. Anything going on? I'm just trying to think. Is anything else major going to happen coming up? And I don't see it. I don't think so. It's been interesting to watch. GameStop. GameStop, how can I put this? If you're on the right side of GameStop and you're trading it, good for you. As you guys can see, the stock is all over the place. It's been running. It's higher. It's lower. I know it was down a little bit today. Did it close flat? So it ended up closing pretty much flat, not too far from where it was. But we sort of had another run up again. Earnings are coming out. For the life of me, guys, I don't know what's making this thing run other than maybe a short squeeze and these guys moving it around. If you're on the right side, go for it. If you're on the wrong side, I'd say get out really quick. I was just reading today where I believe it was Bill Gross. In fact, I know it was Bill Gross made a couple $1 million shorting. I believe, no, I'm sorry. He was writing some options against GameStop. Now, I'm not sure if he was writing calls or writing puts, but he wrote options against GameStop and he made something like $10 million. Again, not surprised. This is what happens in the volatile market, volatile for security. And again, I don't know how to play this. I wouldn't play it. And again, if you do play it, and the options have become really expensive again. So that's the reason why Bill Gross wrote the options. For those who don't understand, when you write an option, all right, you're writing that contract. That means you're obligated. You have to fill. If that option had gone against Bill Gross, he would have lost money. Now, here's the deal. The reason why he wrote it. When GameStop starts to run and makes those type of moves that it's making, the options price increases because of volatility. All right, let me say it again. When the stocks become more volatile, when the prices become more volatile, you see bigger moves in the stock price. What happens is it's going to increase the premium that these puts cost or these options cost, and premium increases. As that premium increases, it makes the options more expensive. As the volatility comes out, the premium will come out of those options also. Again, for those of you who know what I'm talking about the Greeks. For those who don't know what I'm talking about, it's okay. As that premium comes out, the value of those options are going to drop. So what you'll see, and a number of you know this, there's a group of investors, and what they'll do is, as the premium gets way too rich, they'll actually write the options because they expect the premiums to come out and the options become cheaper. So they're going to write the option, the premium comes out, then they'll buy it back, they'll close out that position because the premium came out. If the premium becomes too narrow, they'll look and say, okay, we expect volatility to come out, volatility is going to increase, and you'll see them actually buy the option because expecting the price to go up because they expect an increase in volatility. If you know what I'm talking about, great. If you don't know what I'm talking about, do some more studying on options. It's somewhat similar to what I talked about last week when I talked about spread trading, where you expect the spread to either widen or spread to narrow. Kind of the same thought process. All right. Any other questions? Anything else I need to go over with you guys today? I will say to you guys, be patient. I'm patiently waiting on the sidelines. Yeah, I'm admitting I'm patiently waiting on the sidelines. I'm seeing some stocks set new highs, but I'm not seeing the follow through that I like to see. So I'm not taking any position in those. I'm on the sidelines waiting. The one good thing about the sidelines, for those of you who actually are on the sidelines in terms of your trading, you can't lose money when you're in cash. You might not make it, but you can't lose it. And the thing I'll say to you guys is, as you go forward, I'm sorry, I got a little distracted. John, how are you? Long time no see, no hear. So again, that's what's going on with the option market. I saw somebody that's just joined the meeting that I haven't talked to and seen in years. Hopefully everything's going well for you, John. All right, guys, John, you just got here, and I'm pretty much wrapping up. We got another 15 minutes, but I had no questions. And John, unless you have a question, do you have a question, John? Type it up. If not, it's good to see you, but I'm about to jump off and get back to doing what I do best, and that is making money in the marketplace and talking about the market. Anybody got anything else going on that they want to share? And all right, I am about to sign off. I do appreciate you guys. Once again, if you're going to do anything, make sure you speak to your advisor. All you're getting from me is my opinion, my thoughts. So hopefully that again, take these ideas, take these strategies, take what I'm talking about, learn from it, speak with your advisor, and use that to make you some money. I'm going to make a statement to you. and this is no offense. That's all right, John. I'm going to say this to you, and this is meant to no offense. When I first got into the business as a broker, as a wealth advisor, one of my clients was an active option trader. He was saying and doing things I had no idea what he was talking about. So I guess what I'm saying to you is, again, is don't be surprised if you start talking commodities or start talking about derivatives with your wealth advisor, and that's not their area of expertise. All right, just so you know, don't be surprised. We all have our area of expertise. Just like if you come to me and start talking about a DRIP program, dividend reinvestments, I'm going to look at you and say, you're speaking to the wrong guy. That's not what I do. So again, know what your lane is, stay in your lane, get advice. If you want to come out your lane, it's not a problem, get some advice. One of the last thing too is, and I mentioned this, again, every day I track price and volume. Every day I go to barcharts.com and I look at price and volume, and I'm looking for stock. I'm looking at these stocks. I'm looking at the ones that are moving on volume and what's going on with their prices. And what you'll start to notice is certain names keep coming up and keep coming up. That reminds me, I have one other one. If I can remember the symbol. Of course, that's not it. Which is going to make me, bear with me one second because I want to bring this up and I need to find the symbol. Of course I can't find it, and I need to go on my phone to find it, but I can't go on my phone because if I'm on my phone, I won't be able to talk to you guys. Is that it? No. All right, so I can't find the symbol, so I guess that means I can't talk about it. And let me just look one other place real quick. I do have a couple minutes. I'm gonna look one other place. If I find it there, great. If I don't, as the saying goes, oh well. I'm on my watch list. So if it's gonna be anywhere to be on my watch list, there it is. Thank you. Jeez. Come on. All right, there it is. Come on. All right. Wow, look at this. Stock finally backed off today. I'll put the symbol up and let you guys look at it yourself. I'm not going to discuss it, but I think it's something that, oops, put up the wrong symbol myself again. Take a look at it, guys. Stock is, I watch it all week. Stock was basically setting new highs. It broke out. It broke out earlier. Broke out about a week ago from 175. Broke out, ran from 175 to 195. It's back down. It backed off today. Backed off, closed low. Backed off yesterday a little bit and backed off again today. So it's at 182. For those who are in the technical analysis right now, it looks like it went back and filled that gap. There's a gap in there. It's an internet security firm, and let me just go back, show you how long I've been watching this. Bear with me a second. Stock went public. Come on. Stock's done some really big moves. I'm just trying to see. Stock went public back in 2010. And the stock for the last for the last year, the stock has been just straight uptrend. So, and it's interesting because, like I said, it's one of the stocks I follow, been following it, and it just keeps going higher and higher and higher. Ask me why I don't own it. Don't have an answer for you. Wish I did, but I don't own it. And it's one of the stocks I track. So it's not like I don't know what's going on. So, but don't ask me. All right. With all that said, I'm about to hop off. I don't see anything else. Hey, Selena, how are you? John, take care. Rest of you guys, take care. Have a great week. And I will speak to you later. Remember, check on these things. Remember what I talked about with product on price and model. And do your research. Start looking. You'll be pleasantly surprised. And when you come across these companies with the product, ask yourself some questions. Could it be the new industry standard? Could it be the new leader? Could this Could this end up becoming is this product and this company strong enough where they could actually become can they curate a whole new market? And by the way, Toys R Us created a whole new market when I talked about it. If you look at that model that Toys R Us uses, the same model that Home Depot and everyone else use. It's the same type model. All right, happy St. Patrick's Day, and have a great day, and I'll see you guys next week. Wall Street Wednesday. Signing out, Professor Milligan.